What we're seeing in the stock market right now is just the calm before the storm. And I'll tell you right now, the radar is showing a pretty nasty storm on the way for the stock market. Now, looking a little bit deeper into what we've been seeing in the stock market lately, it's actually been pretty good. The stock market, or SPY, has been struggling ever since 2022 at this upward resistance level, and basically we're finally breaking above that upward resistance level. So that's awesome to see. But the thing is, we can't celebrate just yet because let's say we have some really dark clouds overhead. So basically, what makes this week so unique is that not only do we have the stock market at a crucial level, not only do we have absolutely giant earnings on the schedule, not only do we have, you could say, big economic data set to release with the unemployment rate, but we also have the man himself, Jerome Powell, set to hike interest rates yet again. And this meeting is very, very unique, and we're going to talk more about this in just a couple minutes. But what we're seeing right now in the stock market is some things that we haven't seen in quite a long time, to say the least. So let's get right into today's episode. So basically right now, we have, for this next meeting on February 1st, there's a 99.8% chance of there being another interest rate hike. So interest rates are set to go up even more, right? This is not a bad thing. But what's very interesting is for this event, there is a 99.8% chance of there being a 25 basis point rate hike, which is something we haven't seen in a little bit. Like over the past, for the most part, over the past year, we've seen some stronger rate hikes. We've seen quite a bit of 75 basis point rate hikes. And, you know, the main reason that we even saw that is because the Federal Reserve needs to slow down inflation, or we're going to see some brutal problems in the economy overhead. So over the past couple of years, inflation has just been out of control, and the rate that it's at is completely unsustainable. Now, what's good is that over the past couple months, we've seen inflation start to slow down, but we can't celebrate just yet because that will not end good at all for the economy. Having inflation continue at levels of 5, 6, 7, or anything higher than that would be devastating for the economy. Ideally, we want inflation to be around 2% or so. But the thing is, right now it looks like the stock market is celebrating way too early as they're pricing in, the next interest rate hike to be only 25 basis points. And honestly, what's very scary is that we're actually seeing a small chance, 0.2% to be exact, of there being no rate hike at all. So like, to me, I look at the stock market and I'm like, it's awesome to see this recovery. It's awesome to see inflation slowing down. Those are good things. But it's like the bond market out here is celebrating way too early. Like the battle has not been won yet. And that's where this is where this meeting gets very interesting, because I really do think Jerome Powell knows that the battle's not won yet, and he kind of has to break it to the bond market, especially saying, it's nice to see, signs of improvement, but we still have a lot of work to do, and I don't think the market will digest that too well. Now, some other things that are worth noting is that for 2023, the FOMC members are all kind of figuring the Fed funds rate to end up around 5.12%, right, give or take. Now, what's also a little scary is that the bond market doesn't see that at all. The bond market right now is pricing in the Fed funds rate to end right around 4.5 to 4.75%. So we're kind of getting like a pretty big difference in that sense. And one of them have to converge. So either the bond market's going to correct or the FOMC members are going to correct. And when that happens, the market's in for some big moves, to say the least. Now, some other things that are worth noting is that the past, couple of months, and honestly just the past year or so, has been really tough, not only for the stock market, but also for the bond market. We've seen some of the most brutal drops in the bond market than we've seen in history, right? And what's very interesting is that if we look at, let's say, bonds, for example, just like a simple CNBC page, we can see that bond yields right now are anywhere from, 4.83% all the way down to, you could say, like 3.53%. You know, we have a lot of variance in that sense. And let's say when we look at like, let's say a 1-year US Treasury a little bit closer, over the past year or so, these yields have been exploding. So like to start 2022, if you wanted to invest in like a 1-year Treasury, you would only get around 0.3% interest. Now you can get around 4.69% interest. So like that is one of the quickest and craziest moves that we've ever seen in the stock market. It's absolutely crazy, and some historic things have resulted from that. So basically, if we look at the yield curve between you could say the yield curve inversion between a 3-month US Treasury and a 10-year US Treasury, it truly is historic. We've never seen it that inverted, and whenever we see significant yield curve inversions, it almost always ends up really bad for the stock market. This is just one yield curve inversion. You can look at the US 10-year, 2-year inversion, or anything you want, but this is just a 3-month 10-year. And if we add the S&P 500 to this, you can see that it is pretty reliable in predicting bad times for the stock market and the economy. So if we enlarge this really quickly, and you can see the S&P 500 is this orange line right here, we can see that the first time that we've had, or one of the first major inversions that we've had between the 3-month Treasury and the 10-year Treasury was in, you could say, late 2000. Guess what happened shortly after that? This dot-com bubble, and there was a lot more selling pressure after that event, right? We can see there was also another significant inversion in, you could say, the later half of 2006. Guess what ended up happening just a year or two later? Quite a sell-off, to say the least. And even if we go on a little bit further, we can see there was another inversion, you could say, at the back half of 2019. Guess what happened the next year? COVID, giant crash. And what are we seeing right now? The biggest inversion on the 3-month, 10-year Treasury curve than we've ever seen in history. So it's like, what's going to happen next? We'll find out. Now, to be fair, looking at the stock market, what we've seen over the past 2 years is something that we've never seen before in history. Like, we've never seen the Federal Reserve pump the market as much as they did, from COVID, and that kind of artificially screwed up the bond market, which is part of the reason that we saw such a brutal sell-off in bonds. So to be fair, over the past couple of years, like, it is like kind of artificially created by the Fed, and that can definitely change things going forward. So keep that in mind. But looking at the stock market right now, like I said, we have a giant day on Wednesday, February 1st, for the FOMC event, and we have Powell speaking. What's also worth noting is that after the event, we also have unemployment data coming out on Friday, 1 hour before market open. The unemployment rate is still very low, which, that's a good thing, and it actually gives the Federal Reserve a lot more room to increase interest rates even further and fully tackle this inflation problem. But I would not be surprised at all if we saw the unemployment rate start to tick up over the next couple months and the next couple quarters. Now, back to like short-term price action and what everyone's really looking at. Not only do we have the stock market at a crucial resistance level, not only do we have huge economic data set for this week, not only do we have Powell set to speak this week, with that FOMC interest rate event, but we also have gigantic earnings. So on Wednesday after close, we have Meta set to report. They're a market-moving company without a doubt, but Thursday is where the big dogs show up. On Thursday after close, we have Amazon, Apple, and Alphabet, aka Google, all set to report earnings. Those three stocks especially have such a large influence on the stock market. So depending on how those earnings go, that can bring in a ton of volatility. So it's like over the next couple of days, we are in for a wild ride. And it can get nasty. And I think the biggest influence will be Powell first. Whatever Jerome Powell has to say at this interest rate event on Wednesday at 2 p.m. to 30 p.m. Eastern time. And the second most important thing will be earnings. Depending on those two events, that can be very brutal for the stock market, but at the same time, Powell just has a way of words sometimes, and the stock market likes to run off of those events too. Most of the time, the stock market has a positive reaction to when Powell speaks, even with all the interest rates hikes that we've seen over the past couple of years. So keep that in mind. But the main thing you need to know is that the rest of this week and just the first couple days and first couple weeks of February will be filled with some truly crazy moves, because we just have like a bunch of crazy events all happening within a couple days. So that's very important. Another thing worth noting is that the stock market this year has actually been very, very good, where we've actually seen some stocks like Tesla up nearly 50%. Meta's up 20%. Netflix is up 20%. Apple's doing good. Nvidia's doing great. So it's like overall, we've seen a lot of great price action, especially with these big tech stocks. And really the only stocks that are selling off are health stocks like Johnson & Johnson, Pfizer, AbbVie, stuff like that. And then just like other value stocks like Procter & Gamble, Coca-Cola, Pepsi, stuff like that. Now, what does worry me a little bit is that have we seen too much of a run-up too quickly? For example, it's awesome to see Tesla running up, let's say 50% in just a couple weeks, but there has to be a limit to it, right? When you have a multi-billion dollar company have a 50% change in just a couple weeks, it gets to a point of like, all right, that move is just a little bit too much. Whether we're looking at Tesla, Apple, or honestly any other stock or even commodity, normally like it's just like you can only move so much in especially a short period of time. Even if there's great news, sometimes these run-ups can be a little bit over-exaggerated and we see a pop back down. So it's like really the way I'm looking at the market right now is we're just at like a crucial point, not only like on a technical level with SPY, but also like on an economic data level as well. So right now it's looking pretty tough for the stock market to see a true breakout unless the events this week are good. So it's like, let's say the FOMC press conference and the interest rate hike is digested in a good way by the market, and let's say earnings are good with Apple, Amazon, Meta, and Google, that can be absolutely amazing for the market, and we might see a brand new leg to the upside in a lot of great moves. But at the same time, all it takes is like one really bad reaction to any of these earnings or Powell speaking, and that can change everything. So all I'm going to say is buckle your seatbelts, be prepared for volatility. I do think there will be a lot of opportunity associated with these earnings reports. Even if we look at Netflix over the past couple earnings reports, you guys don't have to gamble and try and predict what a stock will do before earnings. A lot of times there's also a ton of opportunity just riding the momentum after the stock already reports earnings. If we look at Netflix over just the past 3 earnings reports, you could see that they reported here and they continued to run up for days after the actual report. We could see the other earnings, the other time they reported earnings in October of 2022. They reported earnings and they continued to run days after. Again, even when they reported this year, they ran up at first, or they gapped up at first, and they continued to run after. So it's like, don't feel the need to just gamble ahead of these reports. A lot of times you can just really see some good moves, even if you just play after the earnings. So besides that, thank you guys so much for watching today's video. If you learned something, make sure to subscribe. When you subscribe, you'll see my videos more often. And make sure to check out the Stocked Up Discord group. It's that first link in the description in the comments down below. It's completely free. We have a bunch of amazing people and traders in here. You'll also get access to some of our free tools, like our popular news tab, our earnings tab, and there's actually a couple free day trades every single day. You can chat and network with a bunch of great people, like I said, and it's completely free. So definitely check out that first link in the description and the comments down below. Besides that, let's have an amazing week.